This is the Chris Berry Show. Expert information on wealth, estate, and tax planning for the second half of life. Information that you can understand. Here's your host, Chris Berry.
Welcome to the show. Very excited this week. We're going to start with a positive focus, just like we do every week. And positive focus is just something to start the show off on the right foot. And so this week's positive focus is a personal one. It's about my son Ryan, who's age 8. He's in 3rd grade at Lakes Elementary. And he's in what's called the highly capable cluster. So a group of kids, they pull out a class for some additional activities. So one of the things that was kind of cool the other day is that they worked on financial goal setting, which of course appeals to me. And so what they had the children do is they would write out what their short-term savings goal is, as well as the long-term savings goal. So something down the line. And so for his short-term goal is he wants to get another bike. So he's a big fan of riding his bike around, and he's thinking about getting another bike. So he wants to save up and purchase a bike all on his own. And he's already doing some chores for Grandma and Papa, and he's offered to mow the lawn. So he's working towards his short-term goal. So it's pretty exciting. And then also his long-term goal, this one kind of threw me for a loop a little bit, especially since I'm not really a car guy, so I don't even know where he got this idea from, is he wrote down that his long-term goal is to purchase a McLaren, which, if you don't know, it's a rather pricey, kind of exotic sports car. I think it was, it's kind of an exotic sports car, so I asked him where he heard about that, and he didn't even remember. Must have seen it on some show or something like that. But apparently that McLaren is going to be cooler than the minivan that I drive right now. So I thought that was good to have a nice kind of moonshot long-term goal, as well as a short-term goal. And obviously with the type of work that I do, that certainly appealed to me. And I applauded him for shooting for the moon with his long-term goal, because if you don't try for it, it won't happen. And so it was really cool that he thought big picture. He was comfortable thinking outside the box and going for something that might be a little bit of stretch. But it's good to have those stretch goals. That's how you grow. So it was good to see the financial lessons that they were teaching the 3rd graders at Lakes Elementary. So that was pretty cool. And then it got me thinking about it's something that as adults that we do as well, is have kind of short-term and long-term goals. I'm a big fan of goal setting, and so I review on a daily basis kind of what the goals for the day are. So I write down kind of 3 of my most important tasks. I call them MITs, my important tasks. And then we do weekly goal setting, so working on projects, and then long-term 1-year goals, 3-year goals, and lifetime goals. And it's something that I've always worked on. And it's important to understand from a financial planning perspective to have these goals as well. And you're going to save for these goals in different ways. And it really gets into income planning, which is one of the 5 pillars of a sound retirement, of planning on your savings, planning on your income. For example, if you're saving for something that you're going to buy this year, then that should be in a savings vehicle that's relatively safe and conservative, and we would call that your now bucket of money. So if you know you're taking a big trip in a month or two, then probably the money that you have for that should be sitting liquid in a checking and savings account with easy access to. Versus if you're like my son, saving for that McLaren, well, you don't want all that money just sitting in a savings account because you're not really earning anything. All you're doing is just contributing to that account. So that would be more of a longer-term goal that we would put maybe in our later bucket, where we're willing to take on a little bit more risk, a little more aggressive. Maybe now it's invested in the market versus just sitting in a fixed checking or savings account. But that should be in your later bucket of money. And again, when we talk about income planning and the time frame of when we utilize money, we like this idea of what we call a bucket plan, of understanding kind of the time frame of when we're going to utilize different assets. So your situation might be a little bit different than my 8-year-old's. He's still in the accumulating wealth stage. But as you get near retirement, it's important to understand that you're kind of switching phases. You're switching from an accumulation stage of the money cycle to now preservation followed by distribution. So you've worked so hard to gather up all these assets, accumulate this wealth, and then a lot of times it takes a different strategy looking at how are we going to distribute the assets? How are we going to utilize these different assets in retirement? Because when we retire, we develop what we call an income gap typically, where now, because we've retired, the money that we had coming in from wages has disappeared, and now we need to talk about how are we going to cover our living expenses. And this is where an income gap typically develops because you only have certain forms of fixed income, for example, Social Security. And now a lot of people are waiting or delaying taking Social Security from the time that they retire. So understand that retiring and claiming Social Security is not married. Those are two different concepts that can occur at different times. But what happens is if you delay taking Social Security, which makes sense a lot of times because every year you wait, you get almost a guaranteed 8% growth on your income from Social Security. But if you do delay taking Social Security, so you don't take it right at 62 or even full retirement age, maybe you wait till age 70, but that's going to create an income gap. And so how do you cover that income gap? And that's where we have that bucket plan approach to covering our income needs, which is one of the 5 pillars of a sound retirement. And we take this bucket plan approach where we want to organize assets, organize this accumulated wealth that you've created based on time horizons. So in our now bucket of money, that's going to be money that we're going to use maybe over the next year. And that's money that's going to be safe. It's going to be liquid. It's going to be easily accessible. And this will typically be your checking and savings account. So this is money to cover your income needs for the year, plus any planned expenses you have for the year. So if my son is looking at purchasing a bike with all of his chore money and his earnings, and it's going to be this year, well, then that money's probably going to be sitting there in a checking account or savings account for him. So that now bucket of money, that's our income needs for the year, plus whatever planned expenses. So for my son, he's planning on purchasing a bike. I was working with clients last week, and they have the goal of going to Hawaii this year. So that's going to be money that they want to have safe, liquid, and accessible. And then also in that now bucket would be whatever your emergency fund is. So if there was a issue with a house, if the roof caved in or the roof starts leaking and you wanted to make sure that you have this money that's safe and liquid and available to cover those emergencies. So that money that you have to help you sleep better at night. So that's all invested in the now bucket. And typically that's relatively conservative, safe, and liquid. And then there's money that you're going to have to access later. And maybe this is 10 years out or so. So for my son, this would be the savings he has for his McLaren that he wants to purchase at some point. So this would be money that's invested later that we're going to utilize later, maybe a time frame of over 10 years out. So this money should be invested differently than the now bucket of money. Typically, this is going to be more aggressive. Maybe it's in the market. Maybe it's taking on the volatility of the market where the market goes up and down, but over time it goes up. So this might be tied to mutual funds and stocks and bonds, just participating in the upside of the market. So that would be that later bucket of money. And then what's important is to understand that you also should have a soon bucket of money. So this is money that you're going to utilize maybe over the next 5 to 10 years. And this money allows your later bucket of money to be invested more aggressively because the market goes up and down, but over a period of, say, 5 or 10 years, it's probably going to go up. But if there was a 2008 that happened, we want to make sure that we're not pulling money out of these later investments Because if you're pulling money during a downturn, that's what we call sequence of return risk, where that can have a dramatic effect on your retirement. So that's why a lot of times we like to have what we call a soon bucket of money. And this will be your income needs for maybe the next 5 to 10 years. So that this money is conservative. Maybe it's invested in indexed investments where if the market goes up, you participate in the upside. If the market goes down, you don't lose anything. So this is money that we feel safe drawing on for income for the next 5 to 10 years. And here's an example of this. So I'm working with clients recently retired, age 62, going to delay taking Social Security till age 70 because we ran a Social Security optimization report and showed that based on what he thought him and his wife's life expectancy, that it would make more sense to delay taking Social Security so that they can participate in that growth of income by delaying taking Social Security, where if you delay taking Social Security, each year you wait, it grows about 8%. And so as we're putting together an income plan, we realized, okay, now he's going to have a income gap. So how are we going to cover the time frame from age 62 to age 70? How are we going to cover that gap? And so we're going to have to draw on his assets. And so what we did is we segregated out that soon bucket of money because he had all his money still at his employer. So it was still at the 401k at the employer. And so the question, and it was all invested in the market. And so the issue was, how can we protect against the sequence of returns, but still managing that income gap? So what we were able to do was position a portion of his money. So we figured out how much we needed in his soon bucket of money. So how much would he need from the time that he retires at age 62 until age 70? So we calculated his annual income gap and then multiplied that by 8 because that's going to be from the time frame of retirement until his Social Security kicks in. And then also we added an inflation hedge in there as well because the cost of bread is always going up. The cost of long-term care, the cost of living is going up. So we added in an inflation hedge. So we had a now bucket of money to cover his income needs for the year, and then we calculated how much money he would need over the next 8 years. And now that bucket of money in that soon bucket, we didn't want it invested fully in the market because of the volatility, the ups and downs of the market. If the market were to go down, then all of a sudden that money we allocated in that soon bucket wouldn't be enough to make it to age 70. So in his situation, what we did is for those 8 years, we've calculated how much income he'd need plus inflation. And with that money in the soon bucket, we looked at an indexed investment product that if the market goes up, you participate in the upside of the market, but if the market goes down, you don't lose anything. And by doing this, what we're able to do is, and we're going to pull out basically 10% a year for those 8 years, is we're going to guarantee that his income needs for the next 8 years until we reach age 70, until Social Security kicks in, he's not going to have to worry about what the market's doing, whether the market's going up or down, because he's guaranteed his income till age 70. And then at age 70, that's when his Social Security will kick in, and then we can look at whether there's going to be an income gap moving forward. But with the Social Security kicking in as well as the required minimum distributions now coming out of those qualified accounts, basically his income needs will be satisfied. And then in the later bucket of money, because we've guaranteed his income for the next 8 years, he felt more comfortable being more aggressive with his investments in that later bucket of money because he knows that over time the market does go up. There are ups and downs, but over time the market has been going up. So he felt comfortable knowing that he's not going to have to worry about necessarily how the market's going to do, that his base level of income need is covered, and that he can maintain the lifestyle that he was accustomed to prior to retirement. So it really gave him peace of mind by understanding and creating an income plan, which is one of the 5 key components to any retirement plan. So in addition to creating an income plan, you need to have an investment plan as well as a tax plan, a legacy plan, and very important, especially these days with people living longer than ever, we need to have a healthcare or long-term care plan. So those are the 5 key components to a sound retirement, and that's how one of the ways that we can create an income plan. And I just thought it was great that my son was learning about short-term and long-term investments and savings at such a young age outside of the house. Obviously, we try to give him lessons in the house, but it was great to see that he was learning about this in school. And if you wanted to learn more about creating a legacy plan and an income plan, then I invite you to attend one of our workshops. And we do these workshops about once a week at one of our different locations. So this Wednesday, coming up, May 22nd at 2 p.m. in Bloomfield Hills, we're going to have one of our Clarity Builder workshops where we learn about legal, financial, tax planning in 3 easy steps. So that's going to be Bloomfield Hills Wednesday, May 22nd at 2 p.m. at our Bloomfield Hills office. And then on Thursday, May 23rd at our Brighton office, we're going to have one of our 6 p.m. Workshops, one of our evening workshops. We don't do these very often, and they fill up fast. So if you want more information on one of these workshops, either May 22nd in Bloomfield Hills or May 23rd in Brighton, then visit our website at thechrisberryshow.com or give us a call at 810-355-2584, or you can always email us at askchris@thechrisberryshow.com. And again, for these workshops, they are free, but you do have to RSVP because they fill up pretty darn quickly. And join us as we continue the conversation where we're going to get into covering something that comes up quite often in these workshops. We're going to talk about deeds and Ladybird Deeds and real estate and types of ownership. So continue the conversation with us as we talk about real estate.
If you or a loved one is facing long-term care costs, make sure you talk with certified elder law attorney Chris Berry from the Elder Care Firm, like Sherry Skelton and her family did from Fenton.
My mother has Alzheimer's. My mom just had a regular will. She didn't have anything set up in a trust. And Chris set up a brand new will, and he got everything rolling. Chris has been extremely helpful. My mom would never have gotten my dad's VA benefits if it wasn't for them. Lori, who actually did a lot of the paperwork for the VA, she was like my new best friend. I talked to her probably 2-3 times a week, and we would be on hold together while we were waiting for the VA to pick up. We were approved, and we never would have been able to do that if it wasn't for them. I can't even begin to tell you what he did for my family.
Hello, I'm attorney Chris Berry. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Protect your assets from probate, long-term care costs, the IRS, and get the governmental benefits you deserve. Visit theeldercarefirm.com today or call 810-214-3800.
All right, welcome back. So in last segment, we're talking about income planning and how my son was saving for his McLaren as well as his bike. Now in our second segment today, we're going to get into real estate. So if my son were to decide to also buy a house in addition to a McLaren, I was actually looking up the cost of a McLaren. It's valued about $280,000. Not pesos or anything like that. So basically, it's the cost of a house for a car. So that's cool. But now what we'll do is we'll talk about kind of real estate, because a lot of times this is one of the most asked questions, and people always have questions, or sometimes when they interact with our website, they're asking questions about real estate. So I thought it'd be good to talk about different types of deeds, quitclaim deeds and warranty deeds and Ladybird deeds, and different types of ownership as well, because it can be a little bit confusing. Like, should I put my house into a trust, or should it be just in my name? And then in our third segment, as always, we're going to get into some of the questions and answers. So if you do have any questions for us, feel free to email us at askchris@thechrisberryshow.com. Again, askchris@thechrisberryshow.com. Or give us a call at 810-355-2584. Or you can go to our website, thechrisberryshow.com, and click through, and there's a link where you can submit a question to us right there online. And if you wanted to get your questions asked and answered in real time, then we invite you to attend one of our workshops. And this month we're in Brighton on Thursday, May 23rd at 6 p.m., and we're in Bloomfield Hills on Wednesday, May 22nd at 2 p.m. And these workshops last about an hour to an hour and a half, where we go over legal, financial, and tax planning for the second half of life. Great workshops. They do fill up fast. So if you are interested, please make sure to RSVP. So I want to talk about real estate and deeds and ownership. And first, we need to understand, in reality, there's only two types of deeds. You can either have what's called a quit claim deed, so it's not a quick claim deed, it's called a quit claim deed, or you can have what's called a warranty deed. So either a quit claim deed or a warranty deed. Those are the only type of deeds technically there are. Really, the only difference between the two is with the warranty deed, you're warranting that you actually have ownership and all the taxes have been paid. Now, with that, some people call a quitclaim deed a deed that's signed but not recorded. So you sign a deed, but the idea is that you don't record it, and then when you pass away, maybe your loved one or whoever the quitclaim deed says you've deeded it to will then take it to the county and record it at that time. So we call that the deed in the drawer trick. So you sign a deed, but you don't record it right away. You just kind of keep it in the drawer, so to speak, or it's at the back of your estate plan. And we're not a big fan of these for a couple reasons. First of all, technically, when you sign that deed, that's the transfer. And when you sign that deed, you need to notify the tax assessor that a transfer has been made. So you need to fill out a property transfer affidavit. And if you don't, they can penalize you and fine you because you're supposed to record that within 45 days from the time of the transfer taking place. So it can create some issues at the tax assessor's office. Also, what happens if you were to lose that deed or a fire or something happens? Well, now the home is going to end up going into probate. So there's an above board way to do this instead of that deed in the drawer trick. A better way to think about this, or a better way to approach this, probably would be to do what's called a Ladybird deed. A Ladybird deed. So a Ladybird deed, what it is technically it's called an enhanced life estate deed. And what this deed is, whether you're using it on a quitclaim deed or warranty deed, you can do it either way. But what this deed says is that the house or the real estate is in your name while you're alive, meaning you can refinance it, you can sell it, you can do whatever you want. But when you pass away, it goes to whoever you've named as a beneficiary on that deed. So the deed will say, for example, John Smith is the grantor, grants to John Smith as an individual for his lifetime, and then upon death, it could go to Mary Smith. So that would be a way to basically create a beneficiary designation for your real estate. And we use Ladybird deeds quite often in our office. And a lot of times we'll use it as a way to fund a revocable living trust. So a big question is, should I put my house into the trust? And the answer I have to give you is that lawyer answer of it depends, because it does depend on what type of trust are you utilizing. If you're using a revocable living trust, there's really no benefit to putting the deed directly into the trust. In fact, there could be some drawbacks of doing this, because when you put it into the trust, you're turning down, if you're a married couple, you're turning down some benefits that the state of Michigan has granted a married couple. And so before I get into that, what I need to do now is help you understand the different types of joint ownership we have. And there's 3 types of joint ownership that you can have, and you'll see how this relates in a second. First, we can have joint ownership with right of survivorship. So let's say I have a cousin, we own a cabin up north, I pass away, we're joint ownership with right of survivorship. I pass away. Now my interest goes to my cousin because we were joint ownership with right of survivorship. Likewise, if there was 3 people listed on the deed, joint ownership with right of survivorship, one person passes away, the 2 survivors are now owners on that property. And then if that one more person passes away, then the last person standing is the owner. So kind of reminds me of, and this is going to date myself a little bit, but there was a movie and then a TV series called Highlander, where it was kind of like magical, and these people were warriors and they'd live forever, but if they kind of cut off one of their heads, then they'd pass away, with the idea that there could only be one. So that's what I think of when I think of joint ownership with right of survivorship. It's like last man standing, there can only be one. If you passed away, it goes to whoever's left on that deed. Now, second way that you could own property jointly would be tenants in common. So again, same situation. My cousin and I own a cabin up north. But now we own it as tenants in common. Well, if I were to pass away, my share wouldn't go to the cousin. My share would now go to my estate. So you see how it's different. It doesn't go to the person named on the deed or the person you're joint with, because your share is a separate share. You're just kind of on this deed together in common. So if I were to pass away with tenants in common, my share would not go to my cousin, but instead would go to my estate. Very different than joint ownership with right of survivorship. Now, the third way to own property is only available to married couples. So if we have a married couple joint on a piece of property, then that form of ownership is commonly called tenants by the entireties. So it's a form of joint ownership with right of survivorship, but now the state of Michigan has granted married couples a level of asset protection, where if one spouse were to, say, get in a car accident or get sued for whatever reason, because the real estate is owned tenants by the entireties, as a married couple, that property, that real estate would be protected from that lawsuit. Now, this is where it comes full circle. So if I have a revocable living trust and I'm a married couple and I deed that property directly to that revocable living trust, then you destroy that tenancy by the entirety. So you're turning away from the state of Michigan's offer of a certain level of asset protection for that real estate. So it doesn't make sense to deed real estate directly to a revocable living trust if you're a married couple. And this is a big issue, and we see this quite often of families with a estate plan. They put together their legacy plan, they have a trust, but they mishandle the real estate portion. So if you deed it directly to that revocable living trust, you're basically turning down the state of Michigan's offer of giving you an extra level of asset protection. Why would you want to do that? Now, the alternative would be, well, let's say you just leave it as husband and wife. Well, if you just leave it as husband and wife, and now the married couple, husband and wife, passes away, then that home would end up going into probate. So we don't want to just leave it in the married couple's name alone. And this is where that Ladybird deed comes into play. So the Ladybird deed says it's in the married couple's names while they're alive, so it protects that tenancy by the entireties. But upon death, because it works like a beneficiary designation, it goes into the trust upon death. So it's one of those rare cases where we can have our cake and eat it too. So we get all of the asset protection provided to married couples through tenancy by the entireties, but we also avoid probate, and we do it on the up and up, where that Ladybird deed is recorded right away. We notify the tax assessor that a transfer has been made, but it's an exempt transfer, so it doesn't uncap any property taxes. And now this is getting a little advanced, and we maintain the step up in basis. So when upon death, if the real estate passes through like a trust or probate or the Ladybird deed, the basis is stepped up, or the value of the asset is now the value at date of death versus the value at purchase. So we do a ton of Ladybird deeds. Now, I said whether to deed it to the trust, the answer to that question is it depends. So if you have a revocable living trust, then we're not going to want to deed it directly to the trust. Instead, we're going to want to utilize that Ladybird deed, which we just described. And also a common question is, why is it called a Ladybird deed? Is this something Ladybird Johnson did? The answer to that's no. It is named after Ladybird Johnson, but there was a professor, I want to say out of Virginia, who wrote a book, or we call it a treatise, just a legal book on different types of deeds. And each type of deed he named after a celebrity. So this enhanced life estate deed, we commonly call that a Ladybird deed. Now, we'll utilize a Ladybird deed if we're doing a revocable living trust. But if we're going to set up an asset protection trust because we want to protect against the devastating cost of long-term care, or we want to build in protection against lawsuits, then we're going to set up an asset protection trust like a castle trust. And in that situation, we're going to deed the property directly to the trust. So now the trust will be the owner of that property. And this is important for a couple reasons. First of all, because it is an asset protection trust, we're protected from lawsuits, creditor actions, etc. with the real estate. So that's important. But most important, now we're protecting the home from the devastating cost of long-term care, assuming we can make it 5 years from the time that we move the home into the trust. Then it would be protected from that nursing home or Medicaid spend down, and Medicaid has a 5-year look-back period. So if we're planning ahead, a lot of times what we'll do is we'll deed the home directly to the trust. Now you might be saying, well, I thought the home was exempt while you're alive. The answer to that is that the home is exempt for Medicaid purposes while you're alive, but the state of Michigan can place a lien on the home. If you were to pass away, the state of Michigan pays out any benefits, and the home ends up going into probate. So to avoid that estate recovery, we like to use that asset protection trust, the castle trust. And then also what the trust does is allows us to sell the property if we want to and have the proceeds of that sale protected because they would remain inside of the trust. So it gives us more flexibility when planning for that real estate if we do have an asset protection trust set up. But if not, then we're doing a Ladybird deed, either with the beneficiary of the Ladybird deed being a revocable trust, or even if we don't have a trust-based estate plan, we might use a Ladybird deed to deed the property to the next generation upon death. So those are the types of deeds. Typically, we do one of two things. We're either doing a Ladybird deed or we're deeding that property directly to the asset protection trust. But what I would not recommend would be that deed in the drawer trick where you sign a deed but you don't record it. A Ladybird deed is a better way of doing things, an above board way to doing things, where we are recording the deed right away. We are notifying the tax assessor. You don't have to worry about losing the deed. So it's an above board way to do that deed in the drawer trick. But if we are setting up an asset protection trust, then we might deed the property directly to the trust using a quitclaim deed or a warranty deed. So we're either doing a Ladybird deed or deeding the property directly to the trust. So something to think about with regards to real estate. If you haven't thought about how is your real estate handled, now's a good time to think about it. A lot of times when we're sitting down with clients who have listened to the radio show and came in for a workshop and then sat down for one of our vision meetings, one of the things we review is how they have their assets titled and whether the real estate is in the trust, whether the real estate is a Ladybird deed, or whether the real estate is just in individual's name, where then it could end up going into probate and you could have some results that you're not necessarily planning for. That's some information on real estate and ownership and different types of deeds. And if you want some more information on this, then we'd invite you to attend one of our workshops. And these workshops, we're doing, like I said, about once a week. And we have some coming up in Brighton on May 23rd at 6 p.m. And then in Bloomfield Hills on Wednesday, May 22nd at 2 p.m. So stick with us as we get into some of the questions and answers from our loyal listeners.
The cost of care for an elderly loved one or a loved one with a chronic illness is shockingly expensive. If you are dealing with the unbelievable cost of care, make sure you get all the benefits you're entitled to. Here's certified elder law attorney Chris Berry from the Elder Care Firm in Brighton.
Most of my clients are really concerned about long-term care costs. They don't know where to turn, and what we can do is put together legal strategies to protect your resources and also bring in additional resources to help pay that cost of care. One of the things that they often say is that I wish I knew about this years prior. And unfortunately, the information's out there, but there's just so few certified elder law attorneys. As the only certified elder law attorney in Livingston County, it's my job to make sure that our seniors, our loved ones, our veterans have the best quality of care possible and the best quality of life possible.
Protect your hard-earned assets from probate, long-term care costs, and the IRS. The Elder Care Firm will get you the governmental benefits you deserve, including veterans benefits and Medicaid. Visit theeldercarefirm.com and schedule a free 15-minute phone consultation. That's theeldercarefirm.com.
Now for one of my favorite segments when we get into some of the questions and answers from our loyal listeners. So if you do have a question, feel free to email us anytime at askchris@thechrisberryshow.com or give us a call at 810-355-2584. Or you can go online to thechrisberryshow.com where you can listen to previous episodes as well as ask us questions. So the first question is from Brad. How can I move my IRA into a Roth inside of my trust? So here we need to talk about just the tax qualifications of money. And think of IRAs and Roths. We call those qualified accounts, meaning there's some type of tax qualification to these different types of accounts. Now, with an IRA, what it is tax deferred. And what that means is you put in pre-tax dollars and then it grows. But then when you take the money out of that account, you have to pay income tax on it. And it's taxed at ordinary income rates. So let's say you have $100,000 in an IRA and you're pulling out $50,000 of that. Well, that $50,000 would be ordinary income. So if you're taxed at 10%, it's going to be a 10% tax that you would pay on that. And it can cause your marginal tax rate to go up because tax rates start at 0 and then it goes to 10% and 12% and 22, 24, 32, 35, 37%. Where if you're married filing jointly making over $600,000 a year of income, your next dollar is getting taxed at 37%. So that's IRAs, that's 401ks, traditional 401ks, that's 403bs. They're taxed at ordinary income rates. And there's rules around when you can pull the money out and when you have to pay tax. So if you're to pull money out of one of these accounts prior to 59.5, unless you have a certain exception, you're going to pay tax plus you're going to pay a 10% penalty. And then from 59.5 to 70.5, you have freedom of doing whatever you want with the money. But if you do pull it out, you have to pay tax. And then if you forget to start taking out your required minimum distributions at 70.5, then they're going to penalize you 50% on top of having to take the tax out. So don't forget to take your required minimum distributions once you're age 70.5. So now, one of the things with the IRA, if it's your IRA, you have to be the owner of it. It works a little bit different for inherited IRAs, so leaving IRAs to the next generation, but you have to be the owner of that IRA. And you cannot have the trust as the owner of that IRA. You could name the trust as a beneficiary, and a lot of times we will. Typically, we'll name the spouse as the primary beneficiary of a qualified account so that they can do a spousal rollover where now that account will become the surviving spouse's. And then the contingent beneficiary typically will name a trust as a contingent beneficiary so that when it becomes an inherited IRA down to the next generation, the kids or beneficiaries, the principal of that can be protected, the income can come out. So you have to be the owner of the IRA. Likewise with a Roth, you have to be the owner of a Roth because it is a qualified account. So one of the things you can do is you can do what's called Roth conversions, where you take money from the IRA pay the income tax, and you convert it into a Roth. Now, a lot of times we like to have other money to pay the tax on that, but you can convert money from your IRA to a Roth. And a lot of people get confused on this, and they think that there's some type of limit on how much you can do. There isn't. You can convert as much of your IRA to a Roth as you want. You just have to be able to pay the tax on it. Where you are limited is with regards to contributions. So conversions to a Roth operate differently than contributions to Roth. They have income limits as well as annual limits that you can contribute to a Roth. Now, the important thing, and this is getting back to your question, is that both of these, if it's your Roth or your IRA, has to be owned by you. So it cannot go into a trust. The trust cannot be the owner of those qualified accounts. You can name the trust as a beneficiary, but you cannot name the trust as an owner. So then the question is, how do I get those funds inside of the trust? Well, this is where instead of doing an IRA Roth conversion of taking it from IRA to Roth, what you could do is you could pay the tax on the IRA, get out of that partnership with the U.S. government. Now you could invest it inside of the trust, where the trust is the owner. So the question is, what can you invest inside of a trust? Well, almost anything. A trust is just like a wrapper, just like an IRA is a wrapper, just like a Roth is a wrapper. So inside of your IRA, you can invest in mutual funds and stocks and bonds and annuities and fixed index annuities. All of those things can be invested inside of an IRA. Well, guess what? Inside of a trust, you can invest in mutual funds. So if you like XYZ mutual fund inside of your 401k or IRA, guess what? You can invest in XYZ mutual fund inside of the trust. Now the trust is the owner instead of you. Now it's not tax qualified though. So what does that mean? That means that any of the growth, unless it's a specific type of investment product, which I'll share in a moment, unless it's if you have any growth, it's not going to be taxed at ordinary income, which is nice. Instead, it's going to be taxed at capital gains, so long-term capital gains. So if you leave it in there for a year, you're going to be taxed on the growth, okay? So that's different than being taxed on the principal or taxed at ordinary income rates. So let's say you have $100,000 inside of your IRA. Let's say it grows to $110,000, and then you pull out $50,000 inside of your IRA. What would be taxed? Well, the $50,000 that you pull out of that IRA would now be taxed at ordinary income rates, which could be 10%, 12%, 22, 24, 32, 35, 37%. That's where it maxes out at. So the entire amount would be taxed that you're pulling out of that IRA. Now, if it's inside of a trust and it's in a taxable investment, taxable account, then it's not going to be taxed at ordinary income rates, but the growth when you sell is going to be taxed at capital gains, but not the entire principal. So same scenario. Let's say we have $100,000, but now it's inside of the trust in a taxable account like a mutual fund. Let's say it grows to $10,000, and then you pull out $50,000. Now, what would be taxed? Well, the growth would be taxed. That would be the capital gain. So when you're pulling out this $50,000, you don't have to pay income tax on the entire $50,000 because a majority of that is principal. You would only have to pay tax on the capital gains tax on the $10,000 of the growth. So, and capital gains tax maxes out it starts at 0% and then goes to 10% and 20%. So it's much more favorable than dealing with ordinary income taxes. Now, you might be asking, well, what if I want a tax-free investment vehicle inside of a trust? Can I do a Roth inside of a trust? The answer is no, because a Roth is a qualified account. But there is one type of vehicle that does allow for tax-free growth that we can invest inside of a trust, or we can utilize inside of that trust. And that would be life insurance that has cash value associated with it. So typically what we're talking about here is what's called indexed universal life insurance. So this is where the trust can be the owner. Your contributions to that go into the trust, and then it can grow because it's tied to the index. It can grow, but because it's wrapped inside of this vehicle that the IRS has given certain tax advantages to, the growth of that cash value inside of that index universal life insurance policy, inside of that trust, grows tax-free. So it's a great vehicle for tax-free growth, and where we can create tax-free income sources, all protected inside of a trust, so protected against the devastating costs of long-term care. Because if you were to have a stroke and need nursing home care, and you have money inside of an IRA, that money is up for grabs. You're going to have to spend that money down and pay the taxes on it. Versus if it's inside of a castle trust, an asset protection trust, and it's invested in an index universal life or any other type of taxable account like a mutual fund, annuity, or whatever, the assets inside of the trust would be protected. So there was a long-winded answer to a question of how can I move my IRA money into a Roth inside of a trust? So the answer, Brad, is unfortunately you cannot move money from an IRA into a trust without getting out of that partnership with the Internal Revenue Service. So you have to get out of that IRA. And I wouldn't suggest if you're looking to protect it inside of a trust, you wouldn't want to look at a Roth. Well, it does have tax-free growth, but still it's unprotected if it's in the Roth. If you need long-term care, well, guess what? That Roth, all that tax-free growth inside of a Roth, you're going to have to spend that money down. Versus if it's invested in a taxable account, or if you look at maybe index universal life insurance inside of the trust is protected. And let's say you didn't even want to look at life insurance as a alternative investment vehicle. Even if it's inside of the taxable accounts, like a mutual fund inside of the trust, that would probably, if you're concerned about long-term care, be a better option than leaving it outside the trust where it's unprotected in that Roth. Tax-free growth is great, but I would rather have taxable growth at capital gains rates that's protected inside of the trust. Because if you start having to pay $8,000 to $10,000 or $12,000 or $14,000 a month for long-term care in a nursing home, all that tax-free growth in that Roth IRA, what good is it for you? Because now you're just growing money that you're going to have to hand over to the nursing home. Versus if you grow that money, even if it's taxable inside of that trust, you're going to have the peace of mind to know that that money is protected from the devastating costs of long-term care. So it's something that we work with our clients on, helping them understand the different types of money they have and how this money interacts with the different types of trusts that are available. It's a confusing area, and that's why it's important to work with someone that really focuses on these different aspects. So you might be listening out there and say, oh, I got a great investment guy, or I have a great estate planning attorney, but we need to make sure all these different pieces of the puzzle fit together, that all 5 pillars of that sound retirement, of having an income plan, having a legacy plan, having an investment plan, having a tax plan, and having a healthcare plan, make sure that you have all these pieces of the puzzle, and make sure it's provided to you by someone that can wrap their arms around each one of those pieces of the puzzle for you, and always do it with your best interest in play. Too often, people are working with people that work for broker dealers, where they're just selling them insurance products or selling them stocks or bonds or calling with a hot tip. What's more important is really developing that plan. And so if you want more information or take the first step in developing a plan, we invite you to attend one of our workshops that we hold basically weekly. And we have 2 coming up this upcoming week. One in Bloomfield Hills on Wednesday, May 22nd at 2 p.m. And then our second one this week is going to be in Brighton on Thursday, May 23rd at 6 p.m. And we talk about creating a plan for the second half of life, a legal, financial, and tax plan for the second half of life. So you've done a great job of accumulating wealth. Now, how are we going to protect that and then distribute it to make sure that your money lasts as long as you do? So that was our first question. That took about 12 minutes. Now we're going to get into our second question, and this is from Debbie. Is there a written formula to manually calculate the amount a person can convert from an IRA to an established Roth IRA while staying in a current tax bracket? So this question is from Debbie. So the question is there a limit, or is there a calculation that can be done to show how much to convert? Well, conceptually, what we call this idea is we call it a bracket bumping. So you look to see how much income you have in your taxable bracket before before you jump up to the next higher tax bracket, because any money you pull out, that's going to be ordinary income. So think of it kind of like a graduated cylinder. As you make more money, you have more annual income, then your marginal tax rate is going to grow. So if you remember those graduated cylinders from chemistry class, you pour in the liquid and you can kind of bend down and look to see at what level it is. And as you pour in more liquid, it's a higher level. Well, similarly with marginal tax brackets, the more income you pour in, whether it's from Social Security, whether it's required minimum distributions, whether it's money from work, whether it's pulling money out of your IRAs, the more income you pour in, the higher your marginal tax rate is. So let's say, for example, we're in the middle of the 10% tax bracket. We would have space. We could pull more money or do Roth conversions from our IRAs to move money either into a Roth or maybe move it into a trust, like we're talking about with the last question. And you just look to see how much space you have before you go up to the higher marginal tax rate. Tax bracket. So the next tax bracket after 10% is 12%. And depending on where you think taxes are going to go in the future and how much money you have in these traditional IRAs or 401ks, you might want to explore the concept, and this is something that we help our clients with, of pulling more money out of those tax-deferred accounts sooner rather than later, because if you don't, in 2025, when the current tax rules are set to sunset, that 12% tax bracket is now going to be a 15% tax bracket. And just by paying the taxes sooner rather than later, you can participate in kind of a tax arbitrage where, because now you're paying the tax at 12% instead of 15%, you're basically saving 3% in terms of taxes. And there's lots of different strategies around this idea of looking at your tax brackets and taking control of creating a tax plan. And that's something that we help our clients with. So hopefully that was helpful. That's all the time I have for questions this week. There's a couple other that I didn't have a chance to get to, so we'll get to those next week. And again, if you do want to see your questions answered live at one of our workshops, we have them coming up in Bloomfield Hills on Wednesday, May 22nd at 2 p.m. and then in Brighton on Thursday, May 23rd at 6 p.m. And these workshops, we cover legal, financial, and tax planning for the second half of life. We try to keep the workshops relatively small, so if you do have questions, your questions will get answered there. And if you do want to RSVP, you're going to have to give us a call or visit our website. The number is 810-355-2584, and the website is The Chris Berry Show. And have a great week. Talk to you next week.
Learn more about Chris Berry and how he can help your family by visiting online at thechrisberryshow.com. That's thechrisberryshow.com. You can also call Chris Berry at 810-355-2584. That's 810-355-2584. This program content reflects the opinions of Chris Berry and his guests, not the Elder Care Firm, AE Wealth Management, or the CJ Berry Group, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal or tax strategy. There is no guarantee that the strategist's statements, opinions, or forecasts provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs. This program is furnished by the Elder Care Firm.
If you or a loved one is facing long-term care costs, make sure you talk with certified elder law attorney Chris Berry from the Elder Care Firm, like Sherry Skelton and her family did from Fenton.
My mother has Alzheimer's. My mom just had a regular will. She didn't have anything set up in a trust. And Chris set up a brand new will, and he got everything rolling. Chris has been extremely helpful. My mom would never have gotten my dad's VA benefits if it wasn't for them. Lori, who actually did a lot of the paperwork for the VA, she was like my new best friend. I talked to her probably 2-3 times a week, and we would be on hold together while we were waiting for the VA to pick up. We were approved, and We never would have been able to do that if it wasn't for them. I can't even begin to tell you what he did for my family.
Hello, I'm attorney Chris Berry. The elder care firm is here to help you and your family find solutions. Call us today.
Protect your assets from probate, long-term care costs, the IRS, and get the governmental benefits you deserve. Visit theeldercarefirm.com today or call 810-214-3800.